Hi, this is Lee Thurburn. In this video, we're going to talk about some conceptual issues that are important when you are planning to raise capital. We're going to start off by talking about the idea of the equity crunch. What this means is that it can be extremely difficult to raise small amounts of capital from investors. Now, debt is different, but investors have a due diligence process that takes time. Let me give you an example of a scenario that would be very realistic. So let's say you're trying to raise money from a venture capital company, and let's say that venture capital company has $100 million of funds that they manage. Now their goal, of course, is to grow that $100 million, but they don't put all $100 million at work at one time. They'll typically have about a 3 to 5 year plan where they intend and target rolling their money over in any investment in 3 to 5 years. So again, let's just keep it real simple and say it's a 5-year strategy for rollovers, which means that out of $100 million, 1/5 or $20 million every year is expected to roll out of an investment and become available and roll back into a new investment. Now, the goal, of course, is for that $20 million commitment, and it's never in a single deal, for that $20 million commitment to generate significant profit. So let's say that 5 years ago, they put $20 million into, let's just say 20 different deals, $1 million a deal. So they had 20 different deals, $1 million a deal, and that money is now maturing in the sense that 5 years later, they're liquidating their investment. They have some sort of an exit event. And so hopefully they're getting $20 million on top of their $20 million back, so, or more. But let's say that they're getting, $40, $50, $60 million is kind of maturing and liquidating out. So they take the excess, the 40 or 50 or $60 million above their 20, and they distribute it to their investors. And then they take the core $20 million and they reinvest it. So this year, they have $20 million of fresh funds that have rolled over that they're ready to invest. What are they going to do with those funds? Well, they're going to look for 20 more deals to put those funds in. So if they have 20 deals that they can spread $1 million each over, they're not just going to take the first 20 deals that come across their desk. They have to investigate these deals. And on average, only about 1% of the deals they look at actually get funded. So that means if this particular fictional venture capital company is going to do 20 $1 million deals, they're going to need to look closely at 10 times that many, 200 deals, because only about 1 out of 10 deals that they look closely at are going to get invested. And if only 1 out of 10 deals that they look closely at gets invested, so they have to look at 10, the reality is only about 1 out of 10 deals they're presented deserves a close look. So what that really means is they're going to have somewhere in the neighborhood of 2,000 deals that cross their desk that they have to look at, boil down to 200, take a close look at 200 and boil that down to 20 and make 20 separate $1 million investments. If they're smart, that's basically the process they'll go through. Now, as they take those 200 deals and do due diligence on those opportunities and boil them down to 20 that they're actually going to put money into, that's going to take them quite a bit of time. Due diligence involves a lot of research, a lot of reading, a lot of contacting people. There's a lot of financial analysis. There's just a lot that goes into due diligence. And the people that do the due diligence are typically pretty bright people, which means they've got a lot of education, a lot of experience, and they are expensive. So most companies, most venture capital companies don't have a lot of analysts. The analysts are the ones that do this. They have a small number of analysts, and those analysts can only do so much. They can only spend so much time working on a deal. So the venture capitalist the company has to put $20 million to work at an average of $1 million a deal. So let's say you come along with a really great deal, but you only need $100,000. Maybe you need $200,000. You need a little tiny amount of money. Well, they're not going to, just because you need less money, they're not going to do less due diligence. So they're going to have to spend as much time doing due diligence on your little tiny deal for $100,000 or $200,000 as they are on a deal that's going to be $1 million or maybe more, but a big deal. And so if they do the effort of the due diligence on your small deal for $100,000 or $200,000, they don't have time. I mean, they're taking time away from doing the due diligence on a bigger deal. So let's say that analyst has $1 million to put to work and they put $100,000 to work with you. And now they have to go find somewhere to put another $900,000 to get that full million out. Well, they have to do twice as much work to put the total amount because they've done a small deal. So what this really kind of boils down to is that small deals can be very difficult to finance. So the equity crunch is the zone where you're just too small to be seriously considered by professional money managers. And to some degree, this means that it's easier to request big money than it is small money, and it's easier to get big money than it is to get small money because you're going to get looked at and investigated, whereas if you fall below a certain threshold, they just simply won't look at you. So out of those 2,000 deals that come in the door, probably half of them are too small, and they just get tossed out initially because they just simply don't fit the parameters in terms of industry type and deal size. So be aware of the equity crunch when you're creating your deal.